This is more pertinent for the hotels. This is the rules on lease and licenses. Any type of lease license, it include goods, intangibles, commercial real property, like hotel stays. The rule is that if the lease interval, so a hotel stay is considered a lease interval. If the lease interval starts before July 1st and ends before July 31st, no HST. So someone books in on June 25th for 2 weeks. They started the lease period before July 1st. It ends before July 31st. You will not charge HST. You will only charge the hotel tax on the full amount and the GST. I did this for, Kelly and I did this for a hotel association here in Kelowna 2 months ago. The feedback I got when I relayed to this is that the July 1st long weekend, I think I have the slide here somewhere, it's right here, sorry. The discussion in the room at that time was, well, maybe what we'll do, and this isn't so much about saving money, because hotel tax, it's either hotel tax or it's HST. It's about your computer system trying to keep this all clean. The feedback I got in the room that day is, I think we're going to check out our clients on the morning of July 1st for the June 30th night, charge a hotel tax and GST, and then check them back in on July 1st, and when they check out again, charge HST on that component. Not so much because there's any shady cost savings, but it's just your systems being able to handle the change in the taxes. So, food for thought. So just continuing on that general rule, if that lease period goes beyond July 31st, so I guess this is more into your, maybe a commercial real property, or this could be equipment, restaurant equipment that you're leasing on a quarterly basis. If that lease period is quarterly and goes beyond July 31st, then the person is required to apportion the amount of PST and HST based on the breakdown or percentage that occurs on the transition date. Again, if I'm a lessor and I have one of those leases, I might do an interim billing on June 30th just to clean this up so my accounting system doesn't blow up on me. Again, there's PST or there's HST, there's a zero-sum game on the tax side. It's just a matter of managing the internal administration of this stuff. So we get all the hotel tax and just pure PST. Again, if your lease period starts before June 30th, ends before July 31st, you still collect PST or you still pay PST, and then the HST kicks in after that. So this slide kind of gives 4 schematics. Lease interval 1 starts and ends before June 30th. That's going to have GST and PST on it. Lease interval number 2 is where it starts before June 30th and ends before July 31st. Strictly GST and PST, no HST. Lease interval number 3 is a poor attempt at trying to show a quarterly lease interval that goes beyond July 31st. PST would be charged on the percentage that occurs before July 1st. HST would be charged from July 1st onwards. And then finally, this transition ends and our headache goes away. Lease interval number 4 just into a pure HST time period. Intangibles I've talked about is very clean at July 1st date. There's some exceptions to that. I won't go into those right at this time. PST wind down. So you stop charging PST on June 30th. But on June 28th, someone comes into your souvenir shop, buys a t-shirt that says I love Cologne on it, and pays PST because it's an adult size, and brings it back to you on July 5th. Oh no, I'm going to go even further, August 5th. Your final PST return is filed by July 23rd. So you're done with PST, you filed your PST return. If you accept a return good that had PST on it up until October 31st, you have to refund the PST. And the BC government will be releasing a rebate form that will allow you to get back the PST that you refunded to your customer. After October 31st, if you actually take the good back, they have to follow, the consumer has to file for a rebate on their own. Final PST returns July 23rd. Other thing about supplemental retail PST or retail sales tax returns, bad debt recovery, so you've written off a bad debt today and you claimed your PST back from the government, you actually recover a part of that bad debt at Christmas time or something. There will be a supplemental return to submit that PST into the BC government. Just a bit of PST 101 versus GST. PST is a use tax. GST is a value-added consumption tax. And so what the difference is that businesses currently pay PST on equipment, all of their inputs that isn't for resale. So if I'm a retail store, I'm not paying PST on my inventory because those are items for resale, but all my shelving, all my equipment, all my stuff that I put in there, I'm paying PST directly on. I hire a contractor to do leasehold improvements. I don't see PST on my bill, but the contractors pay PST on all those materials, and it's embedded in the cost of that. So businesses are currently paying PST to the extent that they're using those particular items. Goods for resale gets passed on to the end user. It's a use tax. GST is a value-added tax. It's a tax on individual consumption. So businesses pay GST on absolutely everything, but they claim these input tax credits. They recover all of this tax through the value chain from the raw material up through the distribution chain, manufacturing chain to the end user. There's all these ITCs going on, and then the individual walks in and buys that T-shirt. They're paying the GST on that, and that ends up what the government gets in terms of revenue. So it is the individual consumer that is paying GST. And consumer is individuals and people who can't claim input tax credits. So your dentists, your doctors, your banks, universities, hospitals, and so on. So when we move from this PST use tax over to the consumption tax, the background on this, cocktail trivia, since GST came in 1991, there's been a push in Ontario to harmonize. Harmonize. Businesses are paying too much tax, yada yada. In fact, in 2005, I did a paper at a symposium where another presenter went on ad nauseum about getting the harmonization in Ontario. 1997, when the Atlantic provinces signed on, the budget actually was supposed to come out in February. Everyone went into lockup. Budget did not get released. It got released March 23rd. The reason was in the back room they were trying to get Ontario to sign on at that time, and they balked. So they got the 3 Atlantic provinces to sign on, released the budget March 23rd, and they got harmonized. Ontario's economy went into the tank. Last year, the auto sector was suffering badly, and I go back to PST as a use tax. Businesses are paying tax on their investment that they make in the province. Ontario wants to encourage investment in Southern Ontario. So they got rid of the PST into an HST so that businesses get all of the tax back on their costs. BC reacted to that announcement 2.5 months later, came up with their own harmonization announcement at the end of July last year. Where I'm going with this is that both Ontario and BC wanted that concept. They also wanted businesses paying a little bit of tax on the GST, HST side of it. So they introduced this concept of paying back input tax credits on certain expenses. So this was released February 19th. There was actually a revision to it on Friday, if I recall correctly, just some housekeeping tidbits. So there's a new acronym. In addition to ITC, there's now an RITC, or Restricted Input Tax Credit. The government has said, when they brought this in, that this will be in place for 5 years and then gradually phased out on a 3-year basis until year 9, and it'll be completely wiped out. This is for large businesses, so it doesn't affect small business. They define large business with annual sales of $10 million or more, and includes all financial institutions, regardless of their revenue and related parties.